You know by now, the balance sheet has really three distinct sections. The assets, and the other side of the balance sheet is the liabilities and owner's equity. So assets equal liabilities plus owner's equity. Break that down into a very simple distinction. What the company owns, the assets, equals what the company owes, liabilities and owner's equity. What we're talking about here today is the owner's equity side of the balance sheet. And owner's equity is really people who own the business. And how do they own the business? What physical embodiment do they have in their own business? Well, they do that through what's called shares. Shares used to be sheets of paper. Now it's not anymore, but used to be sheets of paper that says, I, Paul Tilley, own a share in this business. And you could have your own shares too. And what would happen is I could buy and sell those shares. So I can buy them for $1. I keep them. A business does really well. I buy them for $1, and maybe I can sell them for $2 next year. Okay? So in that sense, the value of them goes up. And they also pay some sort of a dividend, meaning that they pay me some, we'll call it interest for lack of a better term, but seeing you're an owner, it's not interest. You're getting a share of the profit of the business will come back to you. You probably know by now, too, that there's also two kinds of shares. There's what's called common shares, which is what the owners have, which is a share of the business. And then we have preferred shares. And a preferred share, as the name implies, is preferred by the owners because if the business went belly up tomorrow, odds are the preferred shareholders would get paid first. Preferred. They're preferred after all. Now, the trade-off with that is, so there's less risk in a preferred share than there is a common share, because if the business pays all its bills and there's nothing left, you don't get anything if you're a common shareholder. A preferred share means that you're preferred to get paid if the business goes belly up. You're also preferred to get paid in a year, because normally preferred shares pay a dividend every year guaranteed. That's not the case for common shares. If the owners decide, if the management group decides not to pay out dividends, you don't get anything. But preferred shares tend to be pretty much like clockwork. They will pay a dividend, which is a payment similar to interest, but it's money that comes to you as part of your ownership of the business. And it works the same way as interest in the sense that it's a chunk of money that you get every 6 months or every year, depending on how it's set up, okay? So the ultimate question is if we have a situation where we're getting this guaranteed flow of money, we know that's an annuity, right? If we own a preferred share, we're going to get a flow or a stream of money, these little payments, these preferred dividend payments, into the future. In fact, infinitely into the future, because the business is designed to last forever. So really, that we can assume that this flow of payments is going to go on forever. And it will pay, say, a 3%, 4%, 2%, whatever, well into the future. So really, we could think about it in terms of that being an annuity, and we could think about getting the present value of that annuity, and that present value of that stream of payments that's going to come into us well into the future should be and will be equivalent to the value of the share. If we're going to pay $10 for a share, we certainly want that stream of money to come in to be equivalent to $10, right? So effectively, what we're dealing with here is a perpetuity, because it's going to go on forever. And we're just going to calculate the value of the preferred share based on the perpetuity of the payment. So there's a couple of scenarios in this particular unit that we're looking at. We're saying, okay, let's find the value of the share. If we're given to say, okay, the payment is going to be this much, and it's going to flow forever, you can find out the value of the share, because what it does is discounts it back and says, okay, this is what it's worth today, and that's how much the share is worth today. And if we're given the price of the share, we should be able to find the interest rate. So we can find one or the other. Okay, so first we're talking about stock valuations and returns. Now, stock valuations, businesses really are a child of their owners. So if the owners own a share of the business is a separate entity. We talked about the entity concept in accounting. You know how the books of the business are kept separate from the owners. all of this stuff indicates or points to the fact that the business is like a person in law, okay? In law. And in that sense, they're created through a person's imagination and entrepreneurial ability. And in order to start a business, the owners need to finance it somehow or another. In order to finance it, they either go out and look for borrowed funds, meaning they pay interest and that it's to non-owners, which is a liability, or they go out and they sell part of the business to potential new owners, and that would be owner's equity. So when the owners invest in a firm, that's called equity financing. And that equity financing, as I say, tends to be in the form of common shares or preferred shares. We're going to look at preferred shares. So preferred shares is what we're focusing on. And preferred shares, because they're preferred, they have some limited voting rights. But the owners of this type of stock receive a dividend on a super regular basis. The money comes in like clockwork on a preferred share. So preferred stock combines the features of debt in that it pays a fixed dividend and the features of equity in which you have some participation in the business. And these things can appreciate in price over time. So preferred shareholders have priority over common shareholders if the company goes bankrupt and if the assets are liquidated. So common stock, on the other hand, entitles the owners to vote at shareholders meetings, elect the board of governors, and this sort of thing, and potentially to receive dividends if dividends are voted out. Holders of common stock exercise control by electing a board of directors and voting on corporate policy, and common stockholders are on the bottom of the priority list because of that. They don't get paid until everyone else gets paid. So what we're looking at in this unit is this valuation. The dividends of preferred stock are different from generally greater than that of common stock. Again, higher reward. When a buyer invests in preferred stock, he or she will have a clear idea of what to expect and how much to expect as a dividend, because dividend is paid on a regular basis. So how do we value preferred stock? Well, preferred stocks have a fixed dividend, which means we can calculate the value relatively easily by discounting the perpetual stream of dividend payments into the future to the present day. So we just take a perpetual stream of money. You're going to get $10 for next 6 months, every 6 months for next forever. And we'll discount that back to now, and we'll say, well, that should be the value of the stock. So value in preferred stock involves simply summing the present values of the preferred stock dividend payment into our perpetuity. So one can determine the cost and the price of preferred stock by taking the annual dividend payment and dividing it by the required rate of return in the marketplace. So that's what the market is paying. The annual dividend payment then can be calculated to find the stock's stated value. So the present value of the perpetuity, or stock value, is the payment divided by the market rate of return. So you can see I have it written out here. The cost or price of preferred stock is equal to the annuity dividend payment, par value times the stated dividend rate, divided by the required rate of return. So here's an example. Find the price of a preferred share given the par value is $100. So these things will have a par value similar to what we saw bonds have, to the preferred dividend rate of 8%, and the required rate of return is 10%. Okay, so the 10% is the market rate. The preferred dividend rate is 8%. So what we need to do is, first of all, find the payment. And the payment is simply the $100 value of the stock multiplied by the 8%. We're assuming an annual payment here, okay? That's another thing I should mention. So 100 times 8%, that will be $8. So the payment will be $8. And the market rate is 10%. That's $8 divided by 0.10. Okay? And that then $8 divided by 0.10 equals 80. So effectively, the cost or price preferred stock is 8% of 100 divided by the 10%, and that will come to the market value of the preferred share at this point in time, considering the market rate of interest, is $80.
We can also calculate the rate of return using this formula right here.
So I've just laid it out here again. To calculate the rate of return of preferred stock, simply multiply the preferred dividend rate by the par value. So we can do the same thing using this formula, okay, using this formula here in order to calculate. So let's say, for example, a preferred stock was purchased for $100 and now has a par value of $80. The preferred dividend rate is 10%. So what we're doing here is calculating the rate of return, okay? So before we knew the rate of return, we were calculating the value of the stock. So it's just flip around the numbers. If you know 2, you can find the third. So we got a rate of return, which is 10% of $100. In this particular case, preferred dividend rate is 10%. That's 80 divided by, in this case, the value of the preferred value of the purchase of the stock, which is $100. 80 divided by 100 is 8%. So we can calculate the percent, or if we're given the percent, we can calculate the price of the share. Okay, so here are some examples just to kind of illustrate the point. And again, pretty straightforward. You just need to do some examples. So A, the Tide Company pays a 25-cent dividend every month, and the required rate of return is 6% per year. Calculate the expected value of the stock. So here's one of the little tricks that you need to be careful of. The dividend is paid every month. The rate of return is given in year. So you need to convert the rate of return to a monthly amount, right? So here's the basic thrust of how to do this. So again, the cost of the preferred stock is the annual dividend payment divided by the required rate of return. So the payment is 25 cents. The dividend is 6%. We do 6%. We divide that by 12 in order to bring it down to a month. And then we get in a decimal, and that's 0.005. 25 cents divided by 0.005 is 50. So that means preferred stock would be valued at $50. In the next instance here, we have find the price of a share of preferred stock given that the par value is $1,000 per share, the preferred dividend rate is 5%, and the required rate of return is 3%. So we've got $1,000 stock. Preferred dividend rate is 5%. So the very first thing we need to do is to say, well, how much interest is that going to pay every year? So 5% of 1,000 is $50. Okay. And then we ask, well, what's the required rate of return? 3%. So we take the $50, we divide it by the required rate of return, which is 3%, which is 0.003. And that means the current value of the stock is just that divided by that would be 1,666.66. Okay, so that would allow us to calculate that. Here's yet another example. Bombardier has 3.5 million shares of 1,000 par value preferred stock. They carry annual fixed coupon rate of 7.5%. The preferred stock has a current market price on December 29th of 1,225.45. Find the rate of return of the preferred stock. So it's $1,000 earning 7.5% annually. So that's $75 is the amount of the dividend. The current market price we know is 1,225.45. So we just take 75 divided by 1,225, just manipulating the same formula. Again, same formula. And that will give you 6.12%. 6.12%. So effectively, here we've calculated the dividend rate.